Yeah, and a reminder of our top story that this is proving to be one of the worst ever one-day drops for stock exchanges here in Europe. Business editor Kate Moody is back with the latest.
Hi, Francois. Absolutely. It's been a Black Monday, Black Thursday, a pretty black week for global stock markets. Let's start with the European close. The FTSE 100 was down nearly 10% at the close. The CAC 40 and DAX lost 12% each. The Milan FTSE was down nearly 17% there now. Now, investors were reacting in part to the U.S. travel ban, in part to the European Central Bank's rather underwhelming announcement of stimulus but no interest rate cuts in an effort to cushion the impact of the coronavirus pandemic on the Eurozone economy. Over on Wall Street, the automated circuit breaker was triggered for only the third time since the financial crisis. It's the second time this week. It halted trade for about 15 minutes after stocks plunged on the opening bell. As you can see, they're slightly paring back some of those losses now after the Federal Reserve announced rather extraordinary measures to address what it described as highly unusual disruptions in the Treasury market. The Dow Jones had plunged as much as 9% earlier. It's its worst day of trading since the crash of 1987. Oil prices are also on pace for their worst week in a decade. International Brent hovering around $33.19 per barrel. US WTI down to $31.37. Now, the European Central Bank did unveil this new raft of stimulus measures earlier on. It underwhelmed investors, but why? Brian Quinn has been looking at the details from Christine Lagarde.
The European Central Bank taking action Thursday as President Christine Lagarde called COVID-19 a major shock to the global and European economies.
Even if ultimately temporary by nature, it will have a significant impact on economic activity. In particular, it will slow down production as a result of disrupted supply chains and reduce domestic and foreign demand.
Among the new stimulus measures announced, an additional 120 billion euros in corporate bond purchases for 2020 under the bank's quantitative easing program, on top of the 20 billion per month in ongoing QE stimulus. Also, a new program of negative interest loans to banks aimed at keeping credit flowing to small businesses, and an easing of capital requirements. The announcement a positive surprise for the banking sector, but underwhelming for investors, since what the plan did not include was an interest rate cut, a tacit acknowledgement that rates are already as low as they can go. The ECB's main deposit rate is currently at negative 0.5%. Most economists say monetary policy, which stimulates demand, is ill-equipped to address the supply shock caused by the virus. Markets, though, had been hoping for a rate cut all the same, after emergency cuts from both the U.S. Federal Reserve and the Bank of England in recent days. Lagarde also called for a major boost in government spending stimulus, criticizing what she called the complacency of EU governments in tackling the economic crisis.
Well, the Australian government earlier announced its own packet of measures to help the economy combat the virus-related slump. The measures worth nearly 18 billion Australian dollars. That's about 10 million euros. It includes one-off cash payments to welfare recipients and grants to small businesses. Monty Francis reports.
In Sydney, a message in the sky for people to wash their hands. It's not the only warning sign on the horizon. With the Australian economy under threat, Prime Minister Scott Morrison has announced a stimulus package worth about 10 billion euros.
Once the virus has run its course, we are making sure Australia can bounce back strongly. For the most affected regions and industries, like tourism and Upper North Queensland, there is a special $1 billion fund to support targeted local recovery plans. And as our economy bounces back, which it will, so will our budget.
The stimulus includes one-time cash payments equivalent to 428 euros for 6 million low-income Australians, a 50% wage subsidy for 117,000 people who work for small businesses, and payments worth 14,000 euros for small and medium-sized businesses to help pay their workers and to boost cash flow. In spite of the announcement, Australian markets tumbled, overcome by worldwide concerns about COVID-19.
The sheer speed and size of the falls we've seen and the huge volumes of shares that are changing hands here and around the globe tells us that we're not at the end of this as yet, and we're likely to see further damage over the coming days and weeks.
Australia was one of the few countries to avoid a recession during the global financial crisis in 2008. But with the coronavirus spreading across the globe and the Australian economy already hurting from devastating wildfires, economists say this time a recession may be impossible to avoid.
All right, well, now we can cross over to London and speak to Ranko Berich, head of market analysis at Monex Europe. Ranko, thanks for being with us this evening. You've been watching the markets for a pretty long time. What's different about today?
Well, I think for starters, equity markets are having by far the worst period of sustained performance since the 2008 financial crisis. This is symptomatic of a very, very precipitous decline in investors' risk appetites. And of course, this is because of fears that the coronavirus outbreak, or the pandemic now, globally is going to lower growth and strain financial and policy systems.
Now, the European Central Bank earlier on refused to cut interest rates. It announced this raft of stimulus measures, which proved to be hugely disappointing for investors. Why?
I think the ECB has perhaps acknowledged the difficulties of using the previous blunt tools that were quite characteristic of Mario Draghi's tenure, so your large rate cuts, your open-ended QE. And the response has been instead to opt for targeted lending measures, so essentially encouraging banks and enabling banks to increase lending to affected businesses. Now, unfortunately, this is not what markets were expecting, and so you've seen really the ECB's measures today do nothing to improve investors' mood in European markets. So you've seen equities take a tumble. One particularly pernicious effect of today's presser has been in the widening of spreads between, for example, Italian and German sovereign bond yields. This, I believe, is a policy blunder on the part of Christine Lagarde, because when she was asked about Italian bond yields, she actually responded, this isn't the ECB's job. And in principle, of course, it is not the ECB's job to narrow spreads between Italian and German government bond debt. But of course, under her predecessor, Mario Draghi, the ECB was able to use a certain degree of ambiguity, in the sense that Mario Draghi assured markets in 2012 that the ECB would do whatever it takes to support Eurozone sovereign bond markets. Now, markets interpreted this as essentially an implicit promise that they would prevent sovereign crises, rightly or wrongly. Christine Lagarde had no reason to take this implicit promise away today, and yet that's exactly what she chose to do. The costs of this measure to the Italian economy, which of course is dealing with the coronavirus outbreak, will be counted in the months and potentially years to come. So it is potentially a very costly communications error from Lagarde.
What options are left then? What could be the next step to support what we have to say is an already weak Eurozone economy?
There is only one option, and that is fiscal policy. We've already seen governments worldwide take these steps. Italy has announced a fiscal package this week. Australia, the United Kingdom, of course, yesterday with £30 billion of coronavirus stimulus. And really the main culprit here in the Eurozone economy is, of course, Germany. It's the Eurozone's largest economy, the one that has the most fiscal space to spend, and of course the one that has had the tightest fiscal policy over the past decade. So that is the solution, really, fiscal policy to stimulate the Eurozone economy. And of course, Christine Lagarde said as much today.
Ranko, just quickly, Wall Street's also heading for another pretty rocky session there, some pretty historic drops over there. U.S. President Donald Trump has said he thinks the markets will be just fine. What's your reaction?
Well, I can't comment on the fate of US equity markets. I'm a FX guy, of course, but what I will say is that if you look at what the New York Federal Reserve has done today, they've announced an expansion in the Fed's balance sheet of $1.5 trillion this week. So obviously policymakers in the US are aware of the dangers of these types of falls to the good functioning of financial markets. So even if the White House is not yet acknowledging how serious this potentially could be for US markets, at least the Fed is for now.
Lots of questions, lots of speculation, lots to watch out for on markets around the world. Ranko Berich, thanks so much for joining us on France 24. Francois, I'll hand it back to you. We'll be back, of course, later on with some more from Wall Street.
Yeah, plenty of food for thought there and what we'll be talking about in the France 24 debate. Many thanks, Kate Moody.